Going through a divorce can be an emotional and challenging time, and it can have a significant impact on your finances. Divorce can be a challenging time, but taking the time to plan your finances can help you move forward with confidence and peace of mind. You can regain control of your financial future and build a stable and prosperous life with the right financial planning. In this video, we'll provide you with practical tips and advice on how to manage your finances after a divorce. Here's what we shall be covering. 1. Understanding the financial impact of divorce. 2. Creating a budget and reducing expenses. 3. Evaluating your assets and liabilities. 4. Protecting your credit score. 5. Retirement planning and Social Security benefits. 6. Taking advantage of tax benefits. 7. Working with a financial advisor. Whether you're newly divorced or have been on your own for a while, this video is for you. So, let's get started on the path to financial stability and success after divorce.
Welcome to the Strategist.
Financial planning for divorced individuals. Number 1. Understanding the financial impact of divorce. The first step in financial planning for divorced individuals is understanding the financial impact of divorce. Divorce can have a significant impact on your finances and your lifestyle. Some of the ways that divorce can affect your finances include: 1. Income. If you were relying on 2 incomes before the divorce, you may now have to adjust to living on 1. This can impact your ability to cover your monthly expenses and meet your financial goals. 2. Expenses. Your expenses may change as a result of divorce, especially if you have children. You may need to cover additional costs for childcare, education, and other expenses related to raising children. 3. Assets. Division of assets is a common issue in divorce proceedings. You may need to sell or divide assets, such as a house or investments, in order to comply with the terms of your divorce agreement. 4. Debts. If you have shared debts with your ex-spouse, such as a mortgage or credit card debt, you'll need to determine how those debts will be divided and who will be responsible for paying them. It's important to take an inventory of your assets and liabilities, including your house, car, bank accounts, investments, and debts, so that you have a clear understanding of your financial situation. This information will help you make informed decisions about your financial future. Number 2. Creating a budget and reducing expenses. Once you have a clear understanding of your assets and liabilities, it's time to create a budget and start reducing expenses. Look for ways to cut back on discretionary expenses like dining out, entertainment, and travel. Focus on necessities like housing, food, and transportation, and see if there are any areas where you can save. A budget can help you see where your money is going and make adjustments as needed. Here are a few steps you can take to get started. 1. Track your spending. Keep track of all your expenses for a few months to get an accurate picture of where your money is going. This will help you identify areas where you can cut back. 2. Evaluate your expenses. Look at your spending and see where you can reduce expenses. Start by cutting back on discretionary expenses like dining out, entertainment, and travel. 3. Create a budget. Use the information you've gathered to create a budget. Make sure your budget includes all of your income and expenses, and allocate your money in a way that aligns with your financial goals. 4. Review and adjust your budget. Regularly review and adjust your budget as necessary. Life changes, and your budget should reflect those changes. Make adjustments as needed to ensure that you're staying on track with your financial goals. A budget is also a helpful tool for managing your money and staying on top of your expenses. Creating a budget and reducing expenses will enable you to prioritize your spending and make the most of your income. Number 3. Evaluating your assets and liabilities. Evaluating your assets and liabilities is an important step in financial planning for divorced individuals. This can help you determine what you need to keep and what you can let go of. If you own a house, for example, you'll need to decide if you want to keep it, sell it, or rent it out. You'll also need to consider your debts, including any mortgage or credit card debts, and determine the best way to pay them off. Here are a few things to keep in mind when evaluating your assets and liabilities. 1. Real estate. Consider factors such as the cost of maintenance, property taxes, and your overall financial situation when making this decision. 2. Investments. Review your investment portfolio to determine if any changes need to be made. Consider your risk tolerance, investment goals, and overall financial situation when making decisions about your investments. 3. Debts. Consider your debts, including any mortgage or credit card debts, and determine the best way to pay them off. You may need to adjust your budget or look for ways to increase your income in order to pay off your debts more quickly. 4. Retirement accounts. Review your retirement accounts, such as 401(k), S or IRAs, and determine if any changes need to be made. Consider factors such as your age, investment goals, and overall financial situation when making decisions about your retirement accounts. This information will help you make informed decisions about your financial future and ensure that you're making the most of your assets. Number 4. Protecting your credit score. Protecting your credit score is also crucial in the aftermath of a divorce. Your credit score can impact your ability to get a loan, rent an apartment, or even get a job. Make sure to monitor your credit report regularly and take steps to maintain a good credit score. This may include paying bills on time, paying down debt, and disputing any errors on your credit report. Here are a few things you can do to protect your credit score. 1. Monitor your credit report. Review your credit report regularly to ensure that all the information is accurate. You're entitled to a free credit report from each of the 3 major credit bureaus once a year. 2. Pay bills on time. Late payments can have a negative impact on your credit score, so make sure to pay all of your bills on time. 3. Pay down debt. High levels of debt can also have a negative impact on your credit score, so try to pay down your debts as much as possible. 4. Dispute errors. If you find errors on your credit report, dispute them with the credit bureau. They are required to investigate the errors and make any necessary corrections. Number 5. Retirement planning and Social Security benefits. Retirement planning is another important aspect of financial planning for divorced individuals. If you're receiving a portion of your ex-spouse Social Security benefits, it's important to understand how this will affect your retirement plan. You may also need to consider other retirement savings options, such as an individual retirement account, IRA, or a workplace retirement plan. Things to keep in mind when it comes to retirement planning. 1. Social Security benefits. If you're receiving a portion of your ex-spouse Social Security benefits, it's important to understand how this will affect your retirement plan. You may be eligible to receive a portion of your ex-spouse Social Security benefits if you were married for at least 10 years and are now unmarried. 2. Individual retirement accounts, IRAs. Consider opening an individual retirement account, IRA, to help supplement your retirement savings. IRAs offer tax benefits and can help you save for retirement on your own. 3. Workplace retirement plans. If your employer offers a workplace retirement plan, consider enrolling and contributing as much as you can. These plans can help you save for retirement and may offer matching contributions from your employer. Considering the above options and developing a comprehensive retirement plan, you can help ensure that you have enough money to support yourself during retirement. This can help you live comfortably and pursue the things you love in retirement. Number 6. Taking advantage of tax benefits. Divorce can also have a significant impact on your taxes. It's important to understand the tax implications of divorce, including the tax treatment of property settlements, alimony payments, and child support payments. You may also be eligible for tax benefits, such as the head of household filing status, which can result in a lower tax bill. Here are a few things to keep in mind. 1. Property settlements. If you receive property as part of your divorce settlement, you may be responsible for paying taxes on any capital gains. 2. Alimony payments. Alimony payments are tax-deductible for the payer and taxable income for the recipient. 3. Child support payments. Child support payments are not tax-deductible for the payer or taxable income for the recipient. 4. Head of household filing status. If you are the primary caregiver of your children, you may be eligible to file as head of household, which can result in a lower tax bill. When you have a clear understanding of the tax implications of divorce and take advantage of tax benefits, you can help minimize your tax bill and maximize your financial stability. A tax professional can help you navigate the tax implications of divorce and ensure that you take advantage of all available tax benefits. Number 7. Working with a financial advisor. A financial advisor can help you develop a comprehensive financial plan that takes into account your unique circumstances and goals. They can also provide guidance on important decisions, such as investing for retirement, managing debt, and protecting your assets. A financial advisor can also help you navigate the emotional and financial challenges of divorce, and provide ongoing support as you move forward. Financial planning is an important step for divorced individuals. Thanks for watching. If you have any questions or comments, please leave them in the comments section below. Don't forget to like, share, and subscribe for more financial planning tips and advice.